it also is expanded to include retirement income and other things such as death benefits, life insurance, and disability benefits. So it just has a wider breadth besides paying money to a person who's no longer working. Now, there are two different types of pension plans, a defined benefit plan and a defined contribution plan. And it's good to keep in mind between the two plans as we move forward. So as I was saying, is there's two different types of pension plans. One is a defined benefit plan and the other is a defined contribution plan. And the thing to keep in mind with both of these plans, like I said earlier, is that we are going to further elaborate on both of them and the accounting for both of them, so it's good to make sure you understand what plan that you have. So first is a defined contribution plan. A defined contribution plan specifies the contributions made to an active employee's individual pension plan account. A good example will be, say, every month or even quarterly, an employer puts money into an individual's account, and based on the earnings of that individual account is your pension plan savings. The employer has no other further responsibility to contribute to the account besides the set amount of payments that it's supposed to make. A defined benefit plan, on the other hand, and I'm assuming most employers here are more familiar with a defined benefit plan. This is really more of a function of time of employment, your age, your compensation, and other factors in your bargaining unit. And so based on the inputs and your tenure at the job, for instance, you'll get a certain benefit over a certain period of time after you stop working. So the types of pension plans, and one thing to know is our presentation today really focuses on defined benefit plans. Like we said earlier, defined contribution is strictly just the amount of money, a set amount of money you set aside into the plan. Single employer, an agent multiple employer, and a cost-sharing multiple employer plans are all defined benefit pension plans. They're all different types. So we're going to discuss each one further. So single employer obviously is basically exactly what it sounds like. One employer puts money aside in a pension plan to pay for the employer's employees' pension benefits. So there's one, obviously, hence the name single employer. An agent multiple employer has the same characteristics of a single employer plan, whereas an employer is going to only pay for the pension obligations of its own employees. However, in order to get a better higher yield on their investments, by pooling their investments together, the hope is to get a higher yield and higher return on their investments. And they also share in the administrative costs of having the pension plan. But like I said earlier, you're still going to only pay for your employees' pension costs. A cost-sharing multiple employer plan, on the other hand, is the same thing as an agent multiple employer plan, where you're going to share assets and liabilities, and you're going to share in the administrative costs and also hope to get a higher yield. But on the flip side, you are, as a cost-sharing multiple employer plan, the employers may be obligated to pay for another employer's pension costs. So it's a slight differentiation. I mean, all three plans share a common characteristic, but with a cost-sharing plan, like I said, the employer may have to pay for pension obligations of another entity or another employer. And one thing to note is to make sure that you understand the pension plan that you're, as an employer, you're offering, because as we move forward in the slides, and like I said on the class on May 27th, each one has different responsibilities an employer must take care of and focus on in order to implement 68. So first, I'd like to say, just take a break here and make sure if anyone has any questions or anything like that. If not, like I said, we'll just continue. Okay, so 67 was implemented last year, fiscal year end 6/30/2014. The pension plans were required to include new reporting, new information in their financial statements, which will then in turn be used to create the valuations that are going to be helping the employers for 68. In essence, it just was a setup or a precursor to 68. It just really helped allow the plans and time to get everything and all the information they need in order to help the employers implement 68. Such things as expanded information tables will be included. There's also an expanded required supplementary information table. So like I said, it just really helps the employers implement 68. So first things is, you might be asking, when does 68 apply? If you put your pension plans in a trust or equivalent, it must meet 3 characteristics. Otherwise, the old rules, GASB 25 and 27, still apply, and 68 is no longer in effect. So those 3 rules here, as you can see here, is the first ones is contributions to the plan are irrevocable. Pension plan assets are dedicated to providing pensions. And thirdly, pension plan assets are legally protected from creditors of the plan members. So like I said, if your pension plan, trust, or equivalent do not meet these 3 criteria, you don't have to worry about 68. So we wanted to first go over and just kind of backtrack and just have everyone get on the same page with some pre-GASB 68 terminology and some things that are going to be phased out. First, these terms is accrued actuarial liability, or AAL. It's going to be replaced with total pension liability. Basically, before 68, prior to 68, this information was in the footnotes as usually as a footnote disclosure, possibly a table. And what it really means is the amount of liability a pension plan actuarial says that an employer owes for pension liabilities. So it's just the total pension liability. The next thing here is an unfunded accrued actuarial liability, or UAL. It too used to be in the footnotes, like I said, as a table or a disclosure. It's being replaced now or phased out as net pension liability, NPL. And in essence, the NPL, or net pension liability, is the amount of money left over that is unfunded. So say your TPL, your total pension liability, is $10 million, and as an employer you pay, say, $4 million in contributions. Your unfunded, which is now called a net pension liability, would be $6 million. So it's just the excess amount of outstanding liability, or the net pension liability, that's outstanding for an employer. Lastly, one of the bigger terms we want to touch on is this an actually required contribution, the ARC. This is obviously just the amount of money an actuary required to be paid towards the pensions in a given period. That being said, and as we'll get to in a few slides later, it used to be strictly just ARC used to just be your pension expense, where now the ARC is a component of pension expense. It's not the sole thing that you report on as your pension expense. So as this next slide here that I have is just kind of touches on the new terminology. So like we said earlier, total pension liability is the total liability due in the aggregate as of the valuation date. Your plan fiduciary net position, your PFNP, reflects the net amount the pension plan has available to pay for the total pension liability. And then your net pension liability is just in essence, it's the product of taking your total pension liability, you subtract out your planned fiduciary net position, or the money that is set aside in your pension plan, and you get a net pension liability, so the outstanding amount due. So as you can see with the calculation at the bottom, NPL is just equal to the total pension liability minus the planned fiduciary net position. The example, like I said, your total pension liability is $10 million. You set aside $4 million in planned fiduciary net position. You're left with $6 million in your net pension liability. Like we touched on earlier with the actual required contribution, in the past prior to 68, this would solely be what you paid to the plan. With the implementation of 68, the focus really goes towards not what you pay towards the plan, but it really shifts the focus towards how the benefits are earned. Your pension liability is earned through service provided. So an employee who works maybe five or 6 years may earns a certain amount of pension liability, or is owed, I should say, a certain amount of pension benefit. As they work longer and longer and get paid more and more, that liability grows. So 68 really focuses on the accruing of that liability over the life of service. So it's just a slight differentiator, but it's important to understand that, because as we move forward with the contributions, you can understand how the liability is grows. And like we said earlier too, the actuarial required contribution is no longer just pension expense. It's one component of pension expense, and we'll go through the complete listing soon. So some key dates with GASB 68. I know everyone's probably had a few concerns over what exactly, what all this really means. In this illustration, we're first assuming that the fiscal year end date is a June 30, 2015 fiscal year end date. That being said, I would like to just kind of focus your attention to the earliest valuation date. Statement 68 stipulates that the earliest evaluation can be is 30 months plus 1 day. We'll get into why it's 30 months 1 day on the next slide, but it's just important to note that as long as your pension plan has a valuation date within 30 months and 1 day, you're in compliance with 68, and that's obviously called the valuation date. And this is when the total pension liability is measured. How much do you, as of that point in time, in total liability? How much do you owe for your pension plan, I should say. That being said, the key date really I think to focus on is the measurement date. The valuation date can be, like I said, 30 months and 1 day, but the actuaries will roll forward the data to June 30, 2014 in our example, because 68 stipulates the measurement date can not be more than 12 months from fiscal year end date. So it's really important that you really understand your measurement date, specifically because, as you can tell, it's obviously 1 year behind the fiscal year end date, and it's really important to keep these dates in mind when we start talking about contributions and deferred outflows, because 68 allows allows employers to report the pension plan, the net pension liability a year behind, in order to have timely presentation of their financial statements. So it's just important really to keep these dates in mind. But like I said, in reality, you should really just focus on your measurement date. This is when the net pension liability will be reported. It's what's going to be on your statement of net position, and for your full accrual funds, it's going to be on your fund statements as well. So with the next slide that we bring up is some key date examples. And like we touched on earlier, the 30 months plus 1 day is really in effect. So those of us using, assuming everyone has a June 30, 2015 fiscal year end date, the earliest valuation date can be 12/31/2012. Due to the varying different days in a month, varying from 30 to 31, obviously withstanding February, which is 28, 29, 29 being every fourth year, but typically most months have 30 or 31 days, so the 30 months plus 1 day is just to help out, so you don't have to get an extra valuation performed in order to adhere to 68. So just, because a couple quick examples we have here, as you said, 6/30/2015 if your fiscal year end date, your earliest measurement date, 12 months being a 6/30/2014, and as our example, it's the early value after one. See, it just kind of pattern to 20/31/2015 year end date. So, and you can see the corresponding measurement dates. So with that, I'd like to just turn it over to Catherine.
Thank you, Cody. In this section, we'll go over some of the key accounting concepts stated in Statements 68 and 71. Please keep in mind that the concepts we discussed here only affect the full accrual statements. Those would be the financial statements of the entity-wide, proprietary funds, and trust funds. There are many factors that can affect net pension liability. Statements 68 and 71 identify certain factors which, when causing changes in net pension liability, their effects should be recognized immediately, while there are other factors whose effects should be recognized over a period of time. This slide here contains example of factors whose effects should be recognized the year that changes happen. In the contrary to the items listed on previous slide, the following items should be deferred and amortized over a period of time. As we discussed earlier, measurement date does not usually coincide with the fiscal year end. Since the net pension liability is measured on the measurement date, contributions made to the plan between then and the fiscal year end should be deferred in current year and will be recognized in the next year as part of pension expense, which we will discuss further in a few minutes. In addition, the difference between expected and actual experience with regards to economic or demographic factors and the changes of assumption about future economic or demographic factors or of other inputs should also be deferred. They should be amortized over the average remaining service life. Also, the difference between actual and projected earnings for a particular year of investment should be netted, deferred, and amortized over 5 years. As an employer, you will get most of these information from the plan report, with the exception of the contribution piece, which you will need to keep track of yourself. Now, let's take a minute to talk about how the deferred outflows and inflows are amortized. If you have our presentation handout printed out, you can jump ahead to the table on slide 24. You will see that the balance of each fiscal year is amortized in layers. As we discussed earlier, these balances are amortized over the average expected remaining service life of employees, with the exception of the difference between actual and projected investment earnings, which is amortized over 5 years. In terms of presentation on the statement of net position, deferred outflows and inflow line items are not netted. So you will see both line items on the statement of net position with the details of each line item disclosed on the footnotes. I will briefly go over this table for those of you who have not yet gotten a chance to look at it. As you see on the table, the balance of deferred outflows and inflows of each fiscal year are separately amortized in a layer format. Here is an illustration of the compositions of deferred outflows and inflows. As you can see, most of the components have both deferred outflows and inflows, and they are not netted. Each of these columns here represent the detail of a line item on the financial statements. In other words, on the statement of net position for this particular employer, you will see a deferred outflows of resources of $5,975 and deferred inflow of resources of $6,061, with the detail here disclosed on the footnotes. Now let's talk about the accounting of plan contributions. This may be one of the trickier concepts in Statements 68 and 71. Hopefully the graph below will help you understand the concept a little bit more. On the left-hand side of the graph, there is the prior measurement date, which was the date the net pension liability was measured for the reporting purposes of prior year financial statements. In the middle, there is the current measurement date, which is the date the net pension liability was measured for the reporting purposes of the current fiscal year. Unless the measurement date equals fiscal year end date, most likely you will also have a third date, which is the current fiscal year end date that we show on the right-hand side. In this example, contributions made between the prior measurement date, which is June 30th, 2013, and the current measurement date, June 30th, 2014, are recognized in the current year as part of pension expense. Contributions made between the current measurement date of June 30th, 2014 and current fiscal year end June 30th, 2015 will be recorded as deferred outflow at June 30th, 2015 and recognized as part of pension expense in fiscal year ended June 30th, 2016. So what will you record on your books? Again, keep in mind that we are only talking about full accrual statements here. For cost-sharing plans, you will record the proportionate shares of the net pension liability, pension expense, deferred outflows and inflows of the pool. For single and agent multiple employer plans, you will record the entire net pension liability. Excuse me. Sorry about that. For single and agent multiple employer plans, you will record the entire net pension liability, pension expense, deferred outflows and inflows as stated on the plan report. Now let's take a moment to talk about pension expense. Unlike the pre-Statement 68 practice, in which pension expense equaled the actuarial required contributions on the full accrual statement, under the new standards, pension expense comprise of many components. They are listed on this slide and the next one. The new pension expense includes service costs, interest on total pension liability, amortization of deferred outflows and inflows, employee contributions, pension plan administrative costs, and other changes in fiduciary plan net position. All these amounts that we have just mentioned will be provided on the plan report. One item that will not be provided on the plan report but is part of the pension expense is the change in deferred outflows for employer contributions made after the measurement date. If you recall our earlier discussion about accounting of contributions made after the current measurement date is not included in the plan report because at the time of the measurement, contributions had not happened yet. Therefore, you as the employer need to calculate this change in deferred outflows. This is an example of how pension expense is calculated. As you can see here, most of the components of pension expense are provided on the plan report. So in this example, the employer would take the pension expense of $5 million from the plan report, which is in the middle of the table, then add in change in deferred outflow for contributions. In this example, the employer made $6.5 million of contributions in prior year, which was recorded as deferred outflow in the prior year financial statements. In current year, the employer made contributions of $7.5 million, which will be recorded as deferred outflow on this year's financial statements. Therefore, the change of deferred outflow for contributions is $1 million, which is a credit to pension expense, causing pension expense to arrive at $4 million. In our next class about how to prepare for the audit, we will discuss journal entries in details. This slide shows the difference of what is considered as pension liability between a defined benefits plan versus a defined contribution plan. Since most of you have defined benefit plans, we will spend more time talking about that. In full accrual statements for defined benefit plans, you should record changes in the total pension liability and changes in plan fiduciary net position. In modified accrual statements for defined benefit plans, you should record only amounts paid to the pension plan, which is the same practice as before. The right-hand side of this slide details what should be recorded for defined contribution plans. Other financial statements impacts. First, transactions related to pension obligation bonds are unaffected. Second, if you have those net pension obligations or assets on your books, those amounts will be netted with the beginning net pension liability as part of the implementation. Third, CalPERS side fund is not considered a separate liability and will now be a component of net pension liability. Lastly, for employers that issue comparative financial statements, since certain data for prior fiscal year will not be available, it will be difficult to restate the beginning net position of prior year. In that case, we suggest that prior year column not to be restated and the reason be disclosed on the footnotes. Now, we would like to mention a few current developments. CCMA has just issued a white paper on the implementation of Statements 68 and 71. We have included a link here so that you can get a copy of the white paper. We highly recommend that you read through this white paper as it focuses on issues that may be encountered by municipalities in California during the implementation. In addition, it contains sample footnotes disclosure that can be useful to you. CalPERS valuation reports can be ordered now. Employers can request for reports through the My CalPERS page. In regards to the fees, CalPERS is charging $2,500 per plan for age and multiple employer plans, $850 per plans for cost-sharing multiple employers, and $350 for school districts. Besides the accounting valuation report, you will also get from CalPERS census data for non-pooled plans and all the information as recommended in the AICPA white paper. In our class next week, we will discuss why these two items are essential to the audits. According to CalPERS, they are trying the hardest to have this information provided to you by the end of June. If you would like to look at samples of the accounting valuation reports, CalPERS have posted these reports on their website. We also encourage you to go onto their website frequently to check for any new development. Lastly, if you participate in a pension plan other than CalPERS, our recommendation is to communicate with your plan administrator about what you will need for the implementation as soon as possible. At this point, I will turn it over to Amy to answer any questions.
If anyone has any questions, you can ask them using the Q&A tab at the bottom of your screen. And on the last slide of the presentation, you'll see a list of our upcoming classes, including the May 27th class that related to GASB 68 and 71, preparing the financial statements for audit. We appreciate your attendance today, and if you have any other questions, you can email them to us. Thank you. Oh, we have a question.
Hello.
We do have one question. Can you please review the contribution deferred outflows? I assume that's related to the contributions after the measurement date. As Catherine had discussed, contributions made by the employer after the measurement date, but prior to the fiscal year end of implementation, need to be recorded as a deferred outflow as of year end. So it gets a bit confusing because the first year of implementation, you have to go back and calculate your contributions from the prior fiscal year and calculate those and act as if they were recorded as a deferred outflow at the beginning of the fiscal year. That's where Statement 71 comes into play. Statement 71 says that if you know all of your deferred inflows and outflows, then related to the pension, net pension liability, then you record it. If you don't know all of them, the only one that you're required to record as a deferred outflow as part of the implementation is related to those contributions after the measurement date. For a single employer plan, if you happen to have one of those, your measurement date may be the same as your fiscal year end, so you would not have a deferred outflow. It's only when your measurement date is different than your fiscal year end. We have a second question regarding whether we think GASB would consider an extension of the 12-month time period for entities with a fiscal year end other than June 30. From the information that we've received from CalPERS, they are not going to be able to provide the necessary information earlier than I believe it's a time period. It's a time period between November of 2015 and February of 2016 for those implementers that have a non-June 30, 15 fiscal year end, because in order to prepare the accounting valuations, they need to have their audited financial statements, which are audited in late fall of 2015, and the specific audit opinions issued on related to each pension plan, agent multiple employer plan, and or the cost sharing plans. But CalPERS will be updating their Q&A on their website as they get more information. But my understanding is that unfortunately, the earliest available information would be, again, very early of 16 of each year. That looks to be the end of the questions. So again, we appreciate your attendance and we look forward to next week. Thank you. Bye-bye. Oh, we have one more question. Yes.
This is Diana. Do you think GASB would listen to have an extension or they just flat out?
At this point, it couldn't hurt to, the question for those of you that can't hear is whether the GASB would consider changing the valuation date, that 30-month and one day time period. It would involve amending a GASB statement, but if they had enough, if there were enough, I don't want to say complaints, that's not the right word, but if there were enough inquiries about changing that information, it might be something they could consider. So that might be something that you want to do, is put in an inquiry with GASB and any other non-June 30 year-end plans that you know, or employers that you know could make requests of GASB, and they may consider it. All right. So that looks to be the end of the questions now. So again, we look forward to your attendance at our next session, and you'll see on the slide on the screen a list of our other upcoming classes. Thank you. Bye-bye.